Hey, what's going on everyone? It's Griffin here, and I hope you're all having a great day as always. Now, in today's video, I wanted to share some thoughts with you about the stock market that I think are really important for all my viewers, as well as pretty much anyone else who invests in the stock market for that matter to hear. So I'd really encourage that you watch this video all the way to the end to really get the full depth of the message that I'm trying to get across. I've been investing in the stock market for many years now, and over this course of time, I've witnessed multiple different market environments, including bull markets, multiple corrections, and even last year's stock crash where my portfolio had wiped out over 25% of its value. But over the past couple of weeks, I've been seeing an ever increasing amount of retail investor fear, uncertainty, and downright distractions, if I can put it this way, that I think are worth addressing. And you may have noticed that I actually haven't posted a video on the channel speaking about stocks or stock market investing in now over a week. Rather, I've been focusing on some other topics and content that I've been wanting to put out for a while now and that I think are of tremendous value. But this is also because I've been taking a step back from stock investing and sort of observing the market from an outside perspective, also keeping a close eye on my own positions and interpreting how I want to move forward with these positions, along with taking a short break from the constant content buzz around why the stock market is going to explode for XYZ reason, or what the next hot stock is that's going to make everyone a boatload of money. And really, that last piece is part of the main issue at hand, where as a content creator focused around investing and stock market investing more specifically, it's very difficult for me to adapt and cope to this type of environment where I've been noticing a large portion, I should say, of the newer retail investing community, having started to invest over the past year, is somewhat disoriented right now in the current market environment, where some positions may have gone down 10 to 20%, and this is following a nice bull market where a lot of investors were FOMOing into stocks and have been on this relentless quest to hop from one growth stock to the next hype stock with the sole intention of making a quick turnaround. The problem with this is that no one is right 100% of the time, and using this strategy, it's pretty much inevitable that at some point in time, you're going to buy some positions that will perform less than expected. And combine this with relentless headlines about why the stock market is going to crash more than ever this week for who knows what reason, and we have a larger pool of retail investors than ever that I would say is downright confused with how the market has been reacting lately and what they should do next. Being a content creator myself in this space, I see the phenomenon firsthand, and I'm also in multiple Facebook stock investing groups where I see posts like these practically on a daily basis that tell me that there are many retail investors that are downright frustrated seeing their account constantly in the red right now, especially if this may be one of the first times that you experience a market pullback in certain industries. I mean, think of it, for individuals who started investing in the bottom of March 2020, this might actually be the first time that you are truly experiencing a market decline after a year-long bull market that made tech investors some hefty returns. But what everyone needs to remind themselves, especially newer investors, is that when you buy stock of a company, you are owning a portion of that business. And so for this reason, the company's financials, their growth prospects, as well as their business operations and highlights, balance sheets, everything that has to do with that company should be in your overall decision as to why you chose to buy into that company in the first place and whether or not you have conviction in the company's success longer term. The reality is that I myself can only do so much research, and I do try to share as much of it as possible with the audience, but some companies or funds that I hold in my portfolio may not be a right fit for your portfolio, or they might just not fit your convictions as an investor. For example, I've recently spoken about why I'm bullish on certain industries like renewable energy, e-commerce, cannabis, telehealth, just to name a few, and it's for this reason that I hold stocks that operate within those industries in my own portfolio. If any of these positions do end up fluctuating in value in the short term, well, I need to remind myself why I bought the company in the first place and whether or not my thesis on this company has changed. Because at the end of the day, I will have done proper due diligence on those stocks anyways that pushed me to buy them in the first place. So theoretically, the price point having fluctuated in value over the short term should really have no impact on the playing field and what I see for these companies or industries in the medium to long longer term. But if you're opening up your brokerage account every day and you're constantly worried about the fluctuations of your account's value, then you need to ask yourself whether or not there is something that you've done fundamentally wrong for yourself in your portfolio's construction. If this is the case, well, your portfolio may be way too focused on higher growth positions that inherently come with higher risk for your level of risk tolerance. And or you may be investing in companies that you just don't know enough about to be comfortable holding on through the ebbs and flows of the market. I'm well aware of the fact that speculative and higher growth stocks seem to get a lot more attention from viewers on YouTube, and it can be somewhat repetitive and boring to constantly see content about core ETF holdings that I hold in my portfolios, as well as financially strong companies that I like to consistently buy into. But at the end of the day, my goal with this channel is to see my viewers succeed longer term in the overall growth of the value of their portfolios, and it's through a proper strategy and asset allocation that this is accomplished. It's also for this reason that I like to make content like this video right here, even though I know very well that it probably won't do too well on YouTube because they like to push out more trendier content. And don't get me wrong here, I do allocate a smaller portion of my portfolio to more speculative and higher growth plays, but that's the key word, a small portion of the portfolio that is allocated accordingly for my level of comfort seeing these stocks fluctuate in value dramatically, and this is not going to have nearly as much of a large impact on the overall variation of my portfolio over time. With speculative stocks, you really should not be allocating more than you're willing to even potentially lose to these positions. But what I'm seeing a lot more of lately is individuals allocating over 50% even of their portfolio to extremely speculative plays, and it's with this scenario that things can go south very quickly. So here it is. I pretty much always recommend holding on to your positions throughout a dip and potentially even adding more to the position, considering a more recent audit of it and determining whether or not your convictions stand considering its recent state. If they do, then great. There's pretty much nothing to worry about, and you can just trust the process and the continued business growth of this company. 90% of the time, for a company that truly is financially sound, and you've confirmed this from doing proper due diligence, well, short-term news pretty much only has an impact on short-term price fluctuations. Now, if you truly are struggling to maintain your positions while they're in the red, well, I'm not going to sit here and say that you should put yourself through mental agony and stress. In this case, selling off some of your positions to regain some peace of mind may be well worth it. But if this is the course of action that you choose to undertake, then I would recommend taking a step back from actively investing in the market, adding new positions, and trading for a given period of time to try and assess what got you into this position in the first place. And when you do choose to actively get back into the market, take a longer term approach to your investing. Craft out a strategy that fits your risk profile and buy positions accordingly in weights that will allow you to maintain conviction in your decisions throughout all market environments. Essentially, don't make the same mistake twice. Of course, you're going to have winning and losing positions even after conducting proper due diligence of every position that you buy into. But at least you will not have allocated over 30% of your portfolio to pre-revenue high speculative plays. Now, what I have been doing and would recommend to other investors who are looking to ride through different market cycles and are looking to invest for the longer term is a combination of holding on to your positions, reassessing each one in order to see whether or not each one still fits with your convictions as to why you bought them in the first place, and then potentially bolster some of your highest conviction positions while also trimming back on other positions that you may have lost faith on for any given reason. Essentially, what I'm saying is viewing this as an opportunity to rebalance your portfolio and allocate more of your capital as well as energy into companies as well as funds and other positions that you see thriving over the coming years for a real fundamental reason, instead of buying them for no reason other than fear of missing out. I'm also looking to potentially rotate out some of these individual positions that I may have lost some faith in based on newer and up-to-date research as well as business developments of the company. And I want to make this clear that there's nothing wrong with having bought into a specific company maybe a couple of months back, or let's say a couple of years back, when the playing field was different for that company in question. This is something that I see quite a few viewers having actually even called me out on in the past, where I will have spoken about a given company for XYZ reason, and for that reason I was bullish on the company at the time. But over the course of time that I was holding that position, either the investment landscape had changed changed or even the company's business development and financial growth had fluctuated from the time that I initially bought in. And it's for this exact reason that when you choose to add a position to your portfolio, it's still very important that even though you did due diligence at the get-go in order to buy into it for the first time, you maintain that due diligence at a minimum biannually, but most likely on a quarterly basis is going to be the most advantageous to stay up to date with what that company is doing. Let's remember here that you own a portion of that company. And if you actually do plan on being an investor for the foreseeable future, well, it's inevitable that you're going to experience more market environments like this one and market cycles that could very well impact the value of your holdings. So again, you should see this as a learning opportunity where we're actually living through a real life market cycle and rotation instead of just reading it in a textbook. Depending on the companies that you're holding in your portfolio, well, chances are that shorter term news is not going to really matter in the long-term growth of these companies. I would also recommend that you take this time to learn how to fundamentally analyze a company for what it truly is from both a qualitative and quantitative standpoint. One of the first things that you need to learn as an investor is how to properly read financial statements, for example. And this is something that I'm sharing more exclusive videos of on my Patreon page over the coming weeks. I'll be releasing some Patreon exclusive content on there, so definitely make sure to check that out. And also, you're going to be able to join the Discord community where we chat on a daily basis about various different stocks that I'm personally interested in, as well as any other stock or topic that the community brings up. Overall, if there's anything that I want you to get out of this video though, it's that you really need to maintain a longer term approach to your investing. I know I've mentioned this so many times and I might sound like a broken record, but when you're investing for the short term in FOMO stocks and not doing any research whatsoever, you're pretty much exposing yourself to multiple burns on a recurring basis. So that is really what I would want you to get out of this video, is that the investments that you make should be after doing proper due diligence, and you should only be investing in high conviction positions that fit within your investing strategy and risk tolerance. So I really hope that this video has maybe helped ground you a bit, which is quite difficult to accomplish in this current market environment with so many headlines and uncertainty surrounding the future state of the market. But if I was able to do that, then the goal of this video was met, and I really hope you enjoyed it. If you did, make sure to smash the like button. It really helps the channel out. And now, if this video did help you out, I'd also encourage you to share it with anyone else who might be glued to their stock brokerage on a daily basis, who needs a dose of reality here for a long-term approach to their investing. So on that note, thanks a lot for watching today's video, and I will see you in the next one.